This week, we will discuss financial statement forecasting. We will go over common-size financial statements and the Forma. The Forma is a financial statement where an organization prepares to consider effect of a potential activity. This can be a new activity or a change in a current activity. For example, if your organization is considering increasing inventory by investing in a new drug, or cutting costs by reducing personnel, these would be examples of changes to the organizational structure of the organization, and therefore a pro forma financial statement will be performed to see these effects. Also, a pro forma is done prior when a company is considering acquiring another company, or when two companies are about to merge. The organization will prepare a pro forma financial statement to assess what would be the potential risk and effect of these new changes, acquiring in a company or mergers or cutting costs. A pro forma financial statement can be a part of a risk analysis of a situation, also for forecasting, and as a part of due diligence. The goals of the pro forma is to conduct a comprehensive analysis of projecting finances in the balance statement and income statements. You would first conduct a common-size financial statement by analyzing the information as percentage. This would be easier to compare within an organization, across time, and compare to other organizations in the same industry. The pro forma is also a great way to assess where areas that has uncertainty. And last is the pro forma allows you to evaluate finances in different scenarios. For example, if you believe that there will be financial cuts in the next fiscal year, you may want to project with conservative numbers. On the other hand, if you're in a company where there's a new drug that's about to be on the market and you believe it will be the next big blockbuster drug, you could be a bit more optimistic with your pro forma. You may want to estimate high sales and higher revenue than the years before if you have the right assumptions to make those adjustments. Well, what would be reasons to make these different assumptions? Since you're projecting your finances, it could be higher or lower than your current state. And generally, there are these principles behind forecasting. For example, you want to first take a look at the current financial statements. Are they representative of the reality? Second is the data that you're going to use to justify these projections. Are you going to increase or decrease the percentage of sales, increase or decrease wages, increase or decrease assets or liabilities on your balance statements? The data that you provide to make these assumptions will have an impact on your outcome. So the saying garbage in, garbage out refers to the fact that if your data is not well supported, your assumptions are not going to be supported, then the outcomes from your projections will be extremely underestimated or way overestimated and will not reflect the reality. Although we cannot predict the future, we can project with some level of certainty that these events could happen and that can allow your organization to function normally and properly with a financial budget. Fourth is having a realistic level of precision. While it's important to make these projections based on solid data, you want to also consider that being too precise of a projection may not make your estimates in the future realistic, and it doesn't give you enough wiggle room. For example, if you forecast to the thousandth decimal place, it won't be very realistic. So, for example, if you think that you're going to have sales that's going to increase by 10.123%, that's very precise. You can easily just say, I believe that my sales will increase by 10%. When we complete our forecasting procedure, we must step back and take a look. and see if it passes the smell test. We want to assess whether the forecast numbers are reasonable. And does it make economic sense? Do they fit with the reality of other financial forces? For example, if you make these projections that the sales will increase by 10%, even though knowing that the market size has shrunk over the year for this product, those projections doesn't make sense in the reality of what's going on in the world. So it's important that to get out of your own comfort zone, your organization, your company, and to step back to observe your data. And last is internal consistency. When you're forecasting the income statement, the balance sheet, and the statement of cash flow, you want to compare to historical data to see that your information is not out of range and that it's within reasonable internal consistency. We have went through the elements of the income statement a few weeks ago. I want to highlight again what were the key elements of an income statement. Income statement would include sales or revenue, depending upon your organization. You would then subtract the sales from the cost of goods to then yield the gross income. Once you have the gross income, you will also consider the operation expenses and also take into account depreciation and also interest expense and taxes. On the balance sheet, you would include your assets and your liability and equity. On the asset side, you will include cash and cash equivalent, account receivable, inventory, any prepaid taxes, marketable security, property, plant, equipment, accumulative depreciation, and any land. On the liability side, you will include debt such as bank loans, account payable, wage payable, tax payable, any long-term debt. And if this is a company, you would include preferred stocks, common stocks, and retained earnings. But if we are looking at a nonprofit organization, you will look at the net assets instead of looking at the equity. Revenue forecasting impacts both the income and balance sheet. In this example, let's assume that there's an increase in revenue. When there's an increase in revenue, cost of goods sold can be impacted because there could be an increase in inventory purchases. Perhaps they need to hire more individuals to deliver the cost of goods. And if there was any property equipment that was purchased, you would also have to consider greater depreciation from these new purchases. Operating expenses could also increase with this increase in revenue because there could be an increase in cost for buyers, maybe marketing, follow up with personnel, logistics, administrative costs. Those would be examples of operating expenses that could also increase because there were an increase in revenue. Or you can think of, in order to increase my revenue, I need to consider increasing my operating expenses. In the balance sheet, cash could increase or decrease depending upon whether there was increase in the revenues from receivables that were collected or payables that are going to be paid. Inventory could increase to generate the increased revenue, or it could stay the same. You could have just raised the price for your inventory. Prepaid expenses would increase. Account payable could increase as a result of additional inventory being purchased on credit. So as you can see, when you want to project an increase in revenue in your pro forma, there's a ripple effect on all these different elements that will be impacted. To conduct a common size analysis, also known as a vertical analysis, is you take all the items on the balance sheet and make them representative as a percentage of total assets. And in the income statement, you take all the elements as representatives as percentage of total net sales or revenue. I will have examples of both balance sheet and income statements being presented as a common size financial statement. A common-size financial statement is a great way to display all the items on a balance sheet and income statement as percentage. It makes it easier for you to compare your organization over time to see if there's any trends. This is the income statement of Coca-Cola Company. As we look closely, the net sales in 2010 was $35,119. The cost of goods sold was $12,693. Using a common size analysis, I would take all the items divided by the net sales. In this case, the cost of goods sold represents 36.1%. I derived that number by 12,693 divided by 35,119. That yields 36.1%. I will continue to do this process for every item on the income statement. I would then compare the year 2010 compared to 2009. Notice the column amounts and notice the column title percentage. By looking at the column percentage, it's easier for you to compare across different years using percentage as compared to absolute. This is the main reason why we conduct common size analysis. Here, you can say the gross margin was 63.9% out of the net sales. Or you can say the gross margin was $22,426 out of $35,119. Which of those two phrases sound more appealing to you? The percentage, right? It's easy for people to grasp percentage and compare that across different years and with industry. This is a summary statement. This shows you the differences and explanations between the two different years. This is the balance sheet of Coca-Cola. You would take all the items on the balance sheet and divide it by the total assets. So for here, the total assets in year 2010 was 72,921. We would take that number as a denominator. The current assets was roughly about 11,199 divided by 72,921 yields a percentage 15.4%. The balance sheet tells us that current assets represents 15.4% out of the total assets. You would also conduct the same analysis for the liability and shareholder equity. Here is a close-up of the balance sheet. See if you're able to calculate the percentage. Cover the column labeled percentage and use the information provided on the balance sheet to conduct your common size financial statement analysis. The common size analysis is also called vertical analysis. Horizontal analysis is comparing the percentage across years and also comparing between agencies. Once you conducted a common size analysis within your organization, you have a better sense of where the funds are being allocated. Is it mostly being allocated for assets, debt, long-term debt? So many different ways that you can look at your organization. Once you conducted a common size analysis within your organization, you can easily compare different organizations with these percentages. For example, this is an income statement comparing Coca-Cola and Pepsi-Cola. The percentage are presented on this table. By looking at the changes or no change between the companies, it can give you an idea of where you stand in the market space. Once you completed the common size analysis and have a different organization to compare with, you can then graph the information. As presented here, you can easily see the percentage of net sales, gross margin, operating income, comparing Coca-Cola and Pepsi. These numbers are a lot more easier for you to compare as opposed to looking at absolute numbers on the balance sheet. Scenario analysis is adding the probability of a certain event occurring. For example, if you anticipate that there will be a percent change between different years on the same assets, and you believe that there's a 50% of that occurring, You will multiply that percentage against that change to give you different scenarios. If you're very optimistic, you can even think this will increase by 200%. These are different ways for you to anticipate what will be information that will be needed to make these different changes, to increase revenue, or to decrease costs, or need to cut costs in certain areas of operation. When conducting a pro forma, you may want to first look at the revenue or the sales and determine what's the item to the sales ratio, as we determined by the common size analysis. Then add any potential growth rate that you anticipate, whether there's information that you know about your organization, there's going to be a merger, or there's going to be some cuts. A negative growth rate could be another possibility. For each projection of change in your pro forma, you need to include the assumptions and the justifications for these assumptions. Are you taking the conservative perspective? Therefore, the growth rate would increase 1% every year as compared to historical data. And perhaps the next following year, you believe that there will be a change in administration leadership and there will be less opportunity for growth. Therefore, you want to take a conservative perspective. If the growth rate between 2010 to 2011 was 1%, the net sales would yield 35,470 in the year 2011. And if I believe with a conservative perspective that the growth rate will remain at 1%, I will yield 35,924. These are ways for you to project what will be possible revenues and sales and other items on your balance sheet and income statement. For the next following year, do you believe that the cost of goods sold would increase? Therefore, it will cost you more to pay for the inventory. An increased value of cost of goods sold would yield a smaller growth margin compared to previous years. This would be a pessimistic scenario. Ideally, you would hope that revenues would keep on increasing, or net sales would be increasing, and the cost of goods sold would either remain the same or decrease if there was discounts, so that your growth margin can continue to increase. In your pro forma analysis, it's important to pick out key elements that you think will make drastic changes in your financial statement. For example, land, property, plant, equipment most likely won't change very much over time. Therefore, it wouldn't make sense to conduct a type of change analysis for those items. Items that would have an impact on your overall cost structures will be revenue, personnel costs, account receivable, account payable, cash and cash equivalent, debt. Those would be key items that you want to evaluate in your pro forma. Use the analysis as a way to guide you the risk analysis, the uncertainties, and the probabilities of success in your organization. What are strengths and weaknesses? What are areas of efficiency? The pro forma is a way to complement the financial ratio analysis. All of these financial statements analysis gives you a bigger picture beyond the balance sheet, income statement, and cash flow. It helps you integrate what the information tells you and what the numbers mean.